Hello, everyone. My name is Josh Stripmatter, and I would like to welcome you to Stripmatter Wealth Smart Money webinar series. Thank you for joining us. Our presentation today is titled Student of the Market and will be presented by Mark Peterson with BlackRock Investments. For those of you that don't know Stripmatter Wealth, we are a registered investment advisor located in sunny downtown Fort Worth, Texas. Our advisors are certified financial planners and fiduciaries, and specializing in retirement planning, investment management, estate planning, and real estate investing. Today's webinar is meant to be purely educational and not meant as tax or legal advice. Please talk to your licensed professional before taking any action. And for more information, including key disclosures, please visit our website at stripmatterwealth.com. If you have questions or you would like to schedule a complimentary consultation, please contact us at 817-210-3444 or email us at clientservice@stripmatterwealth.com. I would also invite you to sign up for our weekly market e-newsletter by going to stripmatterwealth.com. And please join us each week for our radio show titled Ask the Experts on Saturdays at 10 a.m. on 1190 a.m. A little bit of housekeeping before we get started. All of you have access to the chat feature, so if you have any questions, please type those in. We'll be happy to answer those for you. Also, today's webinar will be recorded and sent to you as a replay, so you're welcome to watch it again or forward it to your friends and family if you think it would be beneficial. So without further ado, please let me introduce our speaker today. His name is Mark Peterson, and he is with BlackRock Investments. Mark is the Director of Investment Strategy and Education and a 20-year industry veteran with extensive experience and expertise educating financial professionals and investors on market and investment topics. Mark is also a native Chicagoan, and he is a lifelong Cubs fan. And unfortunately, the Cubs are doing about as well as the Rangers right now. Mark, is that right?
Yeah, unfortunately, that's true.
Let me stop sharing here and we'll set you up here. Thanks again for being here.
Absolutely. Thanks, Josh. Thanks, everybody, for having me on your call today to talk a little bit about the markets and what we're seeing out there. It's been a pretty good run here the last year or so after a wild ride, and certainly not a shortage of content, right? Certainly a lot to talk about between the economy, the market, the virus. And we'll talk about it through the lens of what we call Student of the Markets, which is something we do monthly and send out to advisors like Josh across the country. And really what we try to do with Student of the Market is lean a lot on history, lean on what has happened in the past with markets and certain events. And we believe it's the old Mark Twain, history doesn't repeat, but it often rhymes. And I think that's especially true with the market. Everything's always different, right? Certainly the last 12 months plus have been very different, but the way the market's reacted is not too dissimilar to what we've seen in the past. So we'll lean a lot on history to give you an idea of what to expect going forward. You know, obviously, I'd be remiss if I didn't mention the virus. You know, certainly the vaccine rollout's gone well. We've seen numbers on the virus come down. Certainly, Texas is a great example of that. But if you just look right now, we're plus 40% of the country's gotten one shot of the vaccine. We're at about a third of the country has gotten both doses. So that starts to get into that range where hopefully we do start to see that curve really start to bend down quite a bit. We've seen that in some other countries like Israel, where they get to a certain level, you know, close to 50% vaccination rate. They really saw their curve really fall off the cliff. So hopefully that's a positive sign for the restart of the economy across the country, right? Not just in a handful of areas, but more durable and more consistent across the country, which I think is really built into the market at this point. All the expectations for a big rebound in economic growth in 2021 is really the expected outcome at this point. You know, really growth that we haven't seen in recent history, just because folks just haven't spent money, they haven't traveled, right? They haven't gone out to eat like they did previous to the pandemic. So a lot of pent up demand, a lot of cash on the sidelines, which we'll touch on. That's could lead to really explosive growth in 2021. So let's jump right in with that. All that said, let's revisit that history a little bit that I mentioned and just talk about where the markets have been the last couple of years. And we'll revisit all the way back to 2019. It's probably hard to remember back anything prior to 2020. right? But think back to the markets. We had a great year in 2019 for both stocks and bonds. US stocks were up over 31%, bonds were up 8.7%. It doesn't get much better than that, right? For the basic building blocks of any portfolio. Then we followed it up last year, even though it was a wild ride to get there. Another really strong year, 18% for US stocks, 7.5% for bonds. Not too shabby, right? Well above average both years. And remember, average for stocks and bonds is about 10 for stocks, 5 for bonds. So 10 and 5 is normally the average. We were well above that in back-to-back calendar years. And we went back in the old time machine. And it's pretty rare to have back-to-back calendar years in which both stocks and bonds had well above average returns, right? You can see it's actually only happened 4 other times in history, going back 95 years to 1926. Most recently in the late 90s, 97, 98, twice in the mid 80s, once in the mid 70s. But prior to that, we didn't have any calendar years back to back where stock and bond returns were well above average. So this is a good news, bad news story. Of course, the good news is we've had some really nice returns for both stocks and bonds. The bad news is history tells us it doesn't last, right? That there's no third year where you get both returns for both stocks and bonds well above average. So something's got to give. And we've certainly felt that way going into the year. The part of the market that probably was going to give was on the bond side, right? Just historically low interest rates. We thought they were low before the pandemic. They went a notch lower during the pandemic. So really low interest rates for bonds and fixed income and cash. And that clearly creates a challenge to maintain these bond returns. And that's what we've seen so far this year through the end of March. And the story hasn't changed too much here. As stocks are positive for the year, we're actually up. We're up 6% through the end of March. We're up over 10% now through the end of April. And bonds are negative. Bonds were down 3.4%. They're right around down 3% through the end of April. So stocks positive, bonds negatives to start the year. This is only the 10th time that's happened, actually, in that 95-year history. And the somewhat good news here is that the rest of the year historically is generally decent for both stocks and bonds when we look at this return pattern. When we started out the year with this stocks positive, bonds negative returns pattern, bonds tend to find their feet a little bit, which we've seen here the last month or so. Interest rates have stopped going up in reaction to that positive economic outlook that I mentioned, but stocks have continued to roll on. So at least history tells us that starting the year with bonds negative and stocks positive is not necessarily a bad thing for the next 9 months. We can pull in all the different 9 other periods where that's been the case. And you can see all kinds of different time periods, right, over that 95-year history. But again, some perspective and context for really how we've started the year. Now, obviously, we'd be remiss if we didn't touch on the bear market last year, right? We hit the 1-year anniversary of the bear market low in March 23rd. Was the anniversary of the low in the bear market. And we just look back at all the history of bear markets back to 1950. And of course, a bear market is a 20% decline. And you can see on average, the decline is about 35%, so well beyond 20%. You can see 1 year following, though, the rebound is greater, up 45%. Next 3 years, you average over 16% per year, those next 3 years. So this year, if we just pull in the table here, and I know there's a lot of numbers here, but look at the far right and look at the rebound that we've had since last March. We're up over 77%, which is the largest rebound of any bear market that we've seen since 1950, 1 year following. So I think that's really critical, again, to put this rebound in historical context. It's been really powerful. And I think one unique thing here that we look at on this chart as well is look at how different all these bear markets are, from the amount they were down, how long they lasted. All have their own unique story, right? They are all unique, all a little different. They all come in all different shapes and sizes. But the one last year was going to be one of the shortest on record. with the fastest recovery and largest recovery that we've seen. So I think that's interesting, and put it in context again from a historical standpoint, that we have had a really nice big run here over the last 12 months since those lows. Now, one of the things that defined the market last year was the biggest stocks in the US stock market were the best performers, right? So the biggest, best known names in the US stock market had really most of the performance for the entire index. And you can see here, we've broken out the S&P 500, which is that US stock market index, by just by grouping them by the largest stocks within that index. So the top 5 largest companies, so that's the Googles, the Facebooks, the Amazons, the Apples, right, the Microsofts of the world, they were up last year on average 52.9%, right? Remember, we said the overall stock market was up 18. Just owning those top 5, on average, you're up over 52%. Even 6 through 20 did pretty darn good, up over 28%. But I always think this creates a little bit of a trap for investors, that investing seems easy, right? You get some of the biggest, best well-known companies, right? Some of these companies we deal with on a day-to-day basis, right? Like Apple, and you just own those companies and you significantly outperform the market. And of course, this doesn't last, right? We all know this doesn't last, but it can really make investing seem easy. And I think we've seen that phenomenon play out, whether it's cryptocurrencies or some of the day trading in some of these areas, makes it really seem easy. And I think that's a challenging trap, because we all know this doesn't last. And if we look at the same chart this year, look at the performance of those top companies versus the bottom companies within that US stock market index. You can see the smaller companies, number 101 through 500, right? So those smallest 400 companies within that S&P 500 are actually the best performers, the opposite of what we saw last year. And I think a lot of folks just missed that reality, right? But it was one of the defining themes that I think we saw last year. And it really turned. It wasn't just at year end. It actually turned in the fourth quarter when we got the vaccine news, right? That we found an effective vaccine that we were rolling out, that it was approved. And all of a sudden, some of those companies that were really punished during the shutdown really rallied in a big way. And some of those are smaller companies, right, that are more tied to the strength of the economy, right? Some of those were some of those cheaper companies, what we call value stocks. And those have really ended up leading the way since that vaccine news in the fourth quarter of last year. So really, it's all tied together, right? You think about some of those top 5 stocks that we mentioned, like Apple and Amazon in particular, they benefited from the shutdown, right? And you saw that in their stock performance last year, really in the first 3 quarters of the year till we got that vaccine news. So all these things tied together, you can really see that shift in stock market performance happening in the fourth quarter when we did have that vaccine news. And it's carried through to 2021, where you're seeing some of those smaller company value stocks really lead the market in 2021. And that's a positive thing, right? We don't want a handful of companies, a handful of stocks being the best performers in the market or the economy, right? We'd rather have a much broader based rally and recovery, right? That's more healthy than just a handful of companies benefiting. The other big theme that we're talking a lot about here at BlackRock is all the cash on the sidelines, right? And I mentioned it earlier, right? We just haven't spent money like we normally would. Record savings rates, right? Record stimulus from the government really getting put into the economy. That's led to a lot of cash on the sidelines for folks. That's going to lead to a lot of spending. And we've really started to see that so far this year in the economy. That's going to lead to a really strong economic growth. I think, as we mentioned earlier, it's pretty well priced into the market at this point. And we've seen some of these peaks with record cash on the sidelines in the past. So this is a chart on the left, just looks at money market accounts. So money market accounts, of course, are those accounts that are invested in very safe short-term instruments that don't move, right, other than pay an interest rate. Excuse me. And you can see historically, we've had some peaks in these assets over time. Most recently, those peaks happened around times where we had market turbulence and economic distress. January of 2009, of course, was the global financial crisis. January of 2003 was following 3 years when the stock market had lost money in 2000, 2001, 2002, following the tech bubble in 9/11. So clearly you can see pretty distinctive peaks in these assets totals. We're actually higher than where we were at December. We're actually at 4.5 trillion at the end of March. So very clear, distinct tops in all this cash on the sidelines. And it's interesting to see what happens to the stock market following these other two previous peaks. Again, lean on history. Look at how strong the stock market was 3 years following 2003 and 2009. You can see the stock market was up on average 16% following 2003. So again, that's average per year. Again, remember, we said the historical average is around 10% per year. And then following 2019, it was even better, up 19% per year for the next 3 years. So this is what we see, what happens historically when there's a lot of cash on the sidelines. That money eventually finds its way back into the market, right? It finds its way back into stocks, can be very supportive of prices in the near term, especially when interest rates are historically low, right? And bond returns are negative. We think this is going to be really supportive of stock prices in the near term. And I think we've already seen that play out here over the last handful of months, right? There's just so many dollars in the sidelines that needs to be put to work. And the best option right now is within the stock market. Switching gears a little bit to talk about bonds and fixed income. You know, we touched on earlier that bonds were kind of the area that was going to give, right? Just historically low interest rates. This is one of my favorite charts, and you can see I have a lot of favorites. But this one looks at interest rates and bond returns going back to the 1920s. The red line is interest rates. So that base 10-year US Treasury yield, and that red line going back to the 1920s. Excuse me. And then we have bond returns by decade in the yellow bars. So interest rates and bond returns by decade. And you can see this tells a nice story. Wherever interest rates start, that's generally where bond returns finish the next 10 years. So, right, look at the 1990s and the 2000s where interest rates started. That's where bond returns finish the next 10 years. And this works pretty well throughout history because most of the return from your bond or fixed income portfolio, it really starts and ends with that interest rate that you're receiving. So you can see the challenge in today's world, of course. At the end of the year, we were less than 1% on that interest rate, right? We were back around 1.5% today, but it's the lowest level that we've seen since the 1940s and 1950s, right? So 70-year history, we haven't seen interest rates this low. The challenge, of course, going forward 10 years from now, we're going to look back and say that bond returns are going to be right around that 1.5% level, right? 1.5% level for bonds over the next 10 years. Again, something we haven't seen in 70 plus years. This is the real challenge in portfolios today, right? We won't have the benefit of a declining interest rate world that we did over the last 50 to 60 years. And that's clearly a challenge in portfolios. And I think one of the ultimate financial ironies, right? If you think about it, that you have all these baby boomers that are getting older, retiring, looking for income and safety in their portfolio. And that area that normally gives us income and safety, fixed income and bonds, is the lowest interest rate level that we've seen since really post-World War II, Great Depression era in the 1940s and 1950s. That's a tremendous challenge to portfolios. Something certainly I think Josh and us at BlackRock can help you with. You need to really be a little bit flexible within your fixed income portfolio, maybe take a little bit more risk, but also balance that with owning bonds, traditional bonds as well, because those provide great diversification for your stock portfolio as well. So it really takes a tremendous balancing act in today's world to get that balance right. based on your situation, based on where you're at in your financial life cycle. Certainly Josh and team can help you with that as well. And the last thing I'll mention is on diversification. I touched it a little bit, just that stock and bond dynamic. This is one of my favorite charts as well, that looks at how well that diversified portfolio has done over the last 20 years through various bull and bear market cycles. And it just highlights the emotional challenge that a diversified portfolio is. I always joke with folks that, you have a really well diversified portfolio if it never feels good, right? If it doesn't feel good, you probably have a pretty good mix of asset classes, right? You haven't put all your eggs in one basket. And just to look at this, we just compared a diversified portfolio to that S&P 500 of the US stock market. And look at the dynamic here that you see play out over the last 20 years is you see that you still lose money in the diversified portfolio when the stock market is in a bear market, right? We touched bear markets earlier. Look at 2008, no better example. The diversified portfolio in this case is a 60-40 stock and bond mix. That's kind of the average for the overall universe, is somewhere around 60% stocks, 40% bonds. But again, it'll depend on where you're at in your life cycle. And you can see we lost almost 25% during the 2008 global financial crisis. One of the worst years ever, calendar years ever for a diversified portfolio. Then coming out of that period, 2009 to 2019, you trailed US stocks by an enormous amount, right? That doesn't feel so good either. The diversified portfolio was up 195%, but the US stock market was up over 350%. So you left 150% of the stock market upside on the table by being diversified, embracing asset allocation. That doesn't feel so good either. It's amazing how many folks we had that were wondering if their asset allocation still made sense, right? And this was the longest US economic expansion in history, that 11-year period. Not the best, but it was the longest. And then, of course, last year was the same dynamic, except in a condensed period, right? Where you lost money in the first quarter, then you had a powerful rally, but if you were diversified, you left a lot of money on the table. And we see this throughout time, right? You still lose money in a difficult market, and you don't make as much money when the bull market returns. So you lose money, you trail, you lose money, you trail. It doesn't feel like you're ever getting ahead with this diversified portfolio. But of course, the punchline here, if we use my fancy animation, is that the diversified portfolio actually ends up ahead here. Not to mention it does so with a heck of a lot less risk, a heck of a lot less drawdown, right? And a heck of a lot less volatility. So for us, this is a great reminder on why we build portfolios the way we do, right? Why we asset allocate and diversify and spread those investment eggs across a variety of investment baskets. This is what we call at BlackRock, winning more by losing less, right? Winning more by losing less. You don't need all the upside of what the bull market brings. If you do a better job in the difficult markets, right? Those bear markets, that actually leads you to a better outcome, right? So for us, it's key to understand that emotionally it's challenging because you get that dynamic of losing money, trailing, and it's natural in this diversified portfolio. But when you step back and try to connect the dots, you can see how powerful it is over the entire 20+ year stretch here. And think about this 20 years too, by the way. I was thinking about this the other day. Pretty historical period in history, right? You have a tech bubble, you have 9/11, you have a global financial crisis, you have that longest US economic expansion in history. Then you throw a global pandemic on top of it. Pretty challenging for both the economy and the market and for all of us as investors. But look at how well the diversified portfolio held up. It actually ended up ahead, not to mention it did so with a heck of a lot less risk than being invested in the overall US stock market. So I think that's just an important reminder. Even some of our best investors we work with need this reminder because it's tough. It's just not intuitive to connect those dots. So for us, that winning more by losing less story is tough to see. But when you take that step back, you can see how powerful it is. So Josh, believe it or not, I think I'm out of slides here. But hopefully that was helpful. Think about where we started, right? It's been a good run the last couple years. We think the economy is going to be really strong with the rebound and the restart more durably and consistently across the country in 2021. I think a lot of that's priced into the market. So certainly we've seen some of that upside built in already, but there's a lot of cash on the sidelines, right, that we think is going to be really supportive of both the stock market and the economy here in the near term. The bigger challenge is going to be on the bond side, right? What do you do in a low interest rate world? When you're looking for income, looking for safety, it's tougher than ever to find. You really need to get that balance right, to maybe take a little bit more risk on the bond side of your portfolio, but make sure you're not taking too much risk, especially after such a good run that we've had since the lows of last March. And of course, as always, remember why we diversify and asset allocate the way we do. It's all to get to that winning more by losing less story. So Josh, why don't I stop there, see if there's any questions, thoughts, or comments out there?
Absolutely, Mark. Thank you very much. Great presentation. So if anyone would like to ask any questions, feel free to type that into the chat bar and we'll answer those questions for you. While we wait for that, Mark, I've got a few comments here. $4.5 trillion in money market funds, that's a lot of money. It's just sitting on the sidelines right now. And I think, as you mentioned earlier, that's going to be a lot of fuel to drive the market moving forward. So that is an astonishing number. I didn't realize that it had gotten that high. And I mean, and it's interesting that it is still that high and that it's gone up in the last month because we've had so much growth just in the last month in the markets. It just seems interesting to me that that number has continued to rise. So I think that's interesting. Also, the 77% increase or rebound is just phenomenal. I mean, that's amazing in its own right. So I am so excited that happened, number one, but number two is that it happened so quickly. I think that was a true blessing in disguise for everybody, is that nobody expected it to come back that quickly. You talked about bonds going lower, and definitely that trend we've been talking about that trend for a long time now. And, I think people kind of get confused about it because, your earlier slide talked about how we had growth in bonds last year and in the previous year before that. But indeed, I think over time it's trending down is the main takeaway for me, is that, and it will probably continue to trend down as interest rates continue to rise. And lastly, I want to comment on your diversified portfolio slide. That is a beautiful slide. I'd like to get that slide from you, actually, because that's something that I've had to answer questions around for many years. And, I love what you said. Winning more by losing less is a phenomenal way of putting that, because, again, it does seem like you're treading water sometimes when you have a diversified portfolio, and yet you see the S&P 500 outpacing it. But then I remember 2008 and that big drop in 2008 and how my diversified portfolios didn't go down as much. And I take comfort in that. And so I love that slide. So those are some of the key things that stood out to me. And I don't see any questions coming through on the chat feature here. Any questions before we end today's presentation? Please type them in now. Otherwise, we will be done, Mark, and we will go on to the weekend and enjoy the weekend. Watch a little baseball. I think that's it. Hey, thanks again for coming on. Look forward to seeing you next time around.
Yeah, absolutely. Anytime. Appreciate it. Any way we can help, Josh.
Thanks, Mark. All righty. Bye-bye.
Take care, everybody.